We think that in the short term, unfortunately, the indicators are not very strong at the moment. But we think that what the Chinese government had done last year will reflect into better growth. Let's say from the second quarter of this year onwards, there are always lags involved in terms of when we see the actual data recovering relative to what we had seen to date. But in the very short term, I'm afraid that the numbers will continue to be quite poor.
We talked about at the introduction to the programme these twin issues of the ongoing trade spat between China and the United States and gradually rising interest rates as key market issues. Could you just focus on those two for us? Is there any prospect in your mind of an improvement early on in the year on the trade issue, given that President Trump was tweeting over the holiday period about a positive phone call with Xi Jinping?
Yes, on trade, we do believe that there are some very positive signs taking place. We think that if you have a look at what China has been prepared to negotiate and give up in terms of reducing the tariffs which they originally imposed on US exports. We think that that is very positive. Also, China now is prepared to buy soybeans from America again. Once again, that is positive. So we think that China actually is prepared to negotiate and do a lot of deals with America in order to try to find a better compromise in terms of the trade with the US. And also, just to make sure that they don't suffer from a 25% increase in the tariffs for the $200 billion, which are currently being talked about, and the $267 billion yet to come. So we think that the steps which have been taken by China regarding trade actually are positive. Regarding the Fed fund rate, I think that you're quite right in saying that obviously we need to see a more, how would I say, a more friendly Fed in terms of trying to talk to the market about possibly introducing a pause in their monetary tightening. I think that would be very positive for not only just for Asia, but for the rest of the world as well. And we believe that actually the Fed is close to announcing that pause, possibly perhaps after March.
And yet, sir, let's go with your narrative again and say that the trade talks end well and we do get a rapprochement between these two superpowers as well. Then we can concentrate on the real issue, can't we? And that is the fact that China has an overheating economy. It has an enormous debt problem. And in fact, the accommodation from the PBOC is creating more worries about debt going forward in 2019. Or is it, sir?
I think that you're quite right in saying that China does have a debt issue. But the thing is, most of that debt is actually funded internally, domestically. So it's not an issue like what the smaller Asian economies suffered in the 1998 Asian crisis, or what Latin America suffered in the early 1990s. Those are different issues because most of the debt at the time actually was based in US dollars. But if you look at Asia and China currently, most of the debt actually is internalized or it is local debt, not US dollar based debt. And as a result of that, we think that China can afford to actually continue to actually ease their monetary policy by cutting the reserve requirement ratio, which still is very high. It's about 14% at the moment. So 14% of the bank's reserves is being confiscated by the Central Bank of China. And if you look at that trend, in fact, before 2007, the reserve requirement ratio, which is held by the PBOC, actually was only 7%. And at the moment, it's 14%. So actually, they can release more liquidity in the Chinese banking system by cutting the RRR ratio. So we think that China can still do a number of things in order to try to help the economy to grow without actually endangering the whole FX regime, or without endangering their debt situation.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.